Good afternoon, ladies and gentlemen. Welcome. My name is GBay99. I hope you all are having a wonderful day. Today we are back with another video, day 2, part 2 of investing week, investing/personal finance week, where in today's video, I'm going to take you guys through a little bit of the process of how I pick stocks. Just what it is that I'm personally invested in, how I pick stocks myself, the different ways that you can measure the value of stocks and how to compare stocks to each other. That's what we're doing today. I'm pretty excited for this. I hope you all are too. So we're going to go ahead and get into that. We're mostly going to be talking about just how to find value in stocks. So there's a number of different investing strategies, but we're going to be talking about investing, right? Long-term investing. You know, we talked yesterday about how if you hold money over a long period of time in investments, then it can build upon itself through compound interest and get really big. There are some people that will trade stocks. Trading is different from investing. Trading, you just buy a stock for a short period of time, sometimes just a day, and then you sell it later. In that instance, you're not really caring too much about the financials of the company or just trying to, predict how stocks will move within a single day. We're going to be talking about long-term investing, though, how to find companies, how to analyze companies and figure out if they're worth investing in or not. So that's what we're going to be doing today. So this is the website that I normally use myself. This is a completely free website. Actually, they do have some sort of I don't know. They have some sort of elite thing. I don't use that. I just use the basic stuff. This is FinViz, FINVIZ.com, standing for Financial Visualizations, which you can see right up here. This is a site that has a lot of great resources. This is the homepage where you can see markets. You can see the Dow Jones Industrial Average over here, the NASDAQ and the S&P 500, how they are all performing throughout the day. Today is a pretty bad day. Right over here, this is also a neat little thing where if you click on this, you can get a more detailed look at the S&P 500. So we can see, the technology sector, how they're performing. We can hover over it and see individual stocks, how they're all doing. Check and see something like Apple. And if you double click on it, then you can go and check out a more detailed version of Apple. But another thing that they have is a stock screener, which this is one of the ways that you can go and try and find value companies that are valued a lot lower than what they possibly should be. You can search through a number of different things. You can see what exchange they're listed on, any index they may be a part of, what sector they're in, consumer goods, financial, healthcare, what industry they're a part of. And there's a lot of different industries, obviously. So this can probably seem a little bit overwhelming. Yeah, this probably seems a little bit overwhelming, I assume, but we're going to go ahead and try and explain a lot of this. Now, firstly, obviously got to give a quick little disclaimer here. Invest in anything at your own discretion. Don't invest anything that you're not willing to lose. I'm just a goofball talking about what I like to do. Don't take this as sound investing advice. But firstly, I will say that the majority of the money that I invest is just invested into the S&P 500. There are ETFs, exchange trade funds, which are very low cost funds that you can go and put money into where they basically just track the market. This is the Vanguard S&P 500 ETF. So when the S&P 500 goes up, this goes up proportional to that. When it goes down proportional to that. This is just a fund that contains all the stocks in the S&P 500, weighted as they are in the S&P 500. So this is what I would advise most people to invest into, right? If I am if you are going to listen to any sort of advice that I give, like we talked about yesterday, the S&P 500 is very, very, safe. It's a safe bet that over a long period of time, some 20 years, 30 years, you will build wealth through the S&P 500. It's also important to mention that the S&P 500 also outperforms even like financial institutions. I think it's something like 92% of financial institutions get beat by the S&P 500. So you're better just investing into an S&P 500 ETF. VOO is one, SPY is another one. You're better investing into one of these rather than going and trying to get a professional financial advisor who's going to try and sell you mutual funds that have really high costs because they're actively managed by, financial people. But 92% of the time, the S&P 500 ends up beating them out. So SPY, VOO, these are just, you can anywhere that you can buy stocks, you can also buy ETFs. They're traded on stock exchanges in the same way. So that's generally speaking where I put most of my money. All right, I want to make that clear. I put most of my money here because, especially if people that have gone to schools and gotten all sorts of degrees in finance can't beat the market, then how am I going to expect to beat the market unless I get extremely lucky? So that's where I put most of my money, and that's where I would advise others to focus on first. But the thing about that is it's kind of boring, right? It's kind of boring when you just go and park all your money into something like this. And I do think that it's a little bit more fun. You can get lucky too, by the way. A fun story. Amazon, when I was very, very young, Amazon was listed on, I forget where it's listed, but Amazon was a public company in like the year 2000, 2004 or something. And back then, they only sold books. And my mom told my dad, Amazon's this really neat company. We should invest in them. And they just never ended up doing it. They were trading at like $3 a share, and now they're trading at $1,600 a share. So there is opportunity for you to get lucky, but you have to understand that that's mostly luck involved. If you're going to try and beat the S&P 500, it's likely not going to happen. And if it does happen, it will likely just be through luck. So please understand that. When it comes to investing in individual stocks, don't invest any money that you're not willing to lose, too, because while you will possibly lose some of your money if you invest in the S&P 500, the worst that could possibly happen during something like a crash or the Great Depression or the Great Recession would be, you'll lose like half of the value. So you will likely always have at least something left over, even if there is some sort of monstrous crash, which would be devastating to a lot of people if they just had if you lost half of your net worth immediately, that would be pretty devastating. But you can always have a little bit of certainty that you'll probably have something left over. But if you go and invest in individual stocks, then you can possibly lose everything. So also please understand that before we get into the rest of this and talk about anything else. If you invest in individual stocks, you can lose everything. If the company goes bankrupt, the stock basically becomes worthless. And that's a very important thing to understand, okay? Because there are people that have done it. There's a streamer out there that I've already mentioned in a couple of these videos already, Reckful. He lost $123,000 betting on one individual stock that ended up going up bankrupt. And, that is a possibility of something that can happen, so please understand that. But with all that being said, investing in individual companies is really fun. It's fun to be the owner of a company, and I'm going to take you guys through a few examples of how you can value a company and choose whether or not you want to own a company yourself or not, or whether they're not a good value, whether they're not a good play. So let's go ahead here and go through some examples. This is an example of a stock that I currently own that is not doing very well. It's not doing very well today. Today's a really, really bad day for the market and also a really bad day for the financial sector. This is Fifth Third Bank. This is a bank that is, I think they're headquartered in Cincinnati. They're a local bank. I know a number of people that use this bank. They're mostly localized to the Midwest, but they're still a kind of decently large bank. I'm personally invested in them partially because I have a little bit of a homeboy bias, right? Because, it's a bank from Cincinnati and I'm from Cincinnati, so let's invest in them, right? It'll be fun. Just something goofy like that. But let's go ahead and show you guys how to analyze a stock and just use them as an example. So over here are the basics, the first few things you need to understand. The market cap is how much the company is worth, right? So this thing right here, the market capitalization, how you get that number is you take the number of shares that currently exist. So Fifth Third has, however many million shares, 694.24 million shares. You multiply that by the price of what it's trading at, and that will give you the market capitalization, which is how much that company is worth. So right now, Fifth Third, as a company, the entire company is worth $21 billion. That's a lot of money. Right here, the income is another thing that's important to know. The sales and income are two different things. Sales are just how much money, if you sell a good, how much you take in from all your sales from selling goods. But of course you have expenses as well. If you're a company where you're selling a product, you're not just getting all the money from all the sales that you make. You also have expenses. It's different depending on what company you have, but you have to pay employees. You have all sorts of different expenses. And so you have to subtract those expenses, and that's how you get income. And the income is a pretty important thing. income to market capitalization, that's really what a lot of people look at. A lot of people look at how much money a company is making compared to how much that company is worth. And that's really a pretty big key that's a pretty big key factor that a lot of people use when valuing whether or not a company is worth more or less than what it's trading at on the stock market. And that income to market capitalization is called the price to earnings ratio, right? The price of the company to how much it's earning. So $21 billion to the $2.2 billion that Fifth Third is taking in. That's the price to earnings ratio. And generally speaking, the price to earnings ratio is something that you want to keep kind of low, okay? You want to have around 10 price to earnings ratio is considered a pretty good price to earnings ratio. There are different companies. Now, this is kind of important to note. Different companies will have different price to earnings ratios that are considered good depending on the financials or depending on the sector they're in. So banks are a pretty normal, predictable financial sector. You know, everyone kind of knows what banks do. They loan out money, they collect interest, and yada, yada, yada. It's not exactly an explosive industry. Sometimes you'll have a company like Netflix. Netflix is currently trading at a 210 price to earnings ratio. By a normal metric, this is outlandishly expensive and completely overvalued, but people are still buying Netflix and the stock is still going up because people think that, you know, cable TV is dying, that Netflix is the way of the future, and that, you know, this can be the thing that takes over the world if cable TV does end up dying. So even though they aren't really making a lot of income compared to what they're trading at, that ridiculous price to earnings ratio, generally in the technology sector, that's considered where most people will say, you know, in technology, if some company comes around and changes the world in some ridiculous way, that's where, you know, people are saying, okay, I want to be a part of that, because if they do change the world, then that's going to be very valuable for the company and very valuable to me as an investor. Biotech is another one. Biotechnologies, Gilead is actually trading. I don't know too much about any of these stocks, but biotechnology is another thing that's constantly kind of getting very large evaluations. Sometimes companies won't make any money at all, so they won't have a price to earnings ratio. They'll end up losing money. But, you know, biotech, that's like developing medicines and stuff. And if there's a company out there that develops a cure for cancer, then okay, that would be incredibly profitable. You want to be a member of that, or you want to be an investor in that company. So biotech is another instance where I think a lot of people are generally considered, a lot of people might be willing to pay higher price to earnings ratios. So those are generally speaking where price to earnings ratios, you have to consider that, right? Sometimes price to earnings might be very high. Sometimes it might be very low. You have to consider, you know, the sector that the price to earnings ratio is in, or the sector that the company is in, to whether or not that price to earnings ratio is fair or not. So anyway, Fifth Third, getting back to this. So right now we can see that they have a price to earnings ratio of about 10, a forward estimated price to earnings ratio over the next fiscal year of about 11. And this is generally speaking considered pretty good, I think. If we go and compare them to another financial institution, JP Morgan Chase, they have similar price to earnings ratios, a little bit higher, another 11 price to earnings ratio. So Fifth Third is maybe slightly undervalued, I'd think, because currently there have been a few things that have happened in the news that one of the reasons that I bought this stock was because there was a huge sell-off that had something to do with Fifth Third currently merging with another local bank. And also there was the Dodd-Frank, part of the Dodd-Frank Act was repealed for smaller banks, which Fifth Third falls under, the definition of smaller banks. So in those instances, I think Fifth Third might end up doing pretty well in the future, and might, the sell-off might not be entirely warranted that we had a few weeks ago. So that's why I'm considering, Fifth Third might be a pretty good bank, pretty good investment, and it'll be fun for me to invest in, a local bank and say that I'm an owner of part of a local bank. So there's a number of different things that you can value a company on. In addition to the price to earnings ratio, the price to earnings to growth ratio is another one. This is what I think most people consider a very important way to value a company. The price to earnings to growth ratio, what they do there is basically they try and figure out, hang on, I can actually pull this up. I can pull up the formula for you on Wikipedia. So the price to earnings to growth ratio, you take the price to earnings and then you divide it by the earnings per share growth. So basically you're trying to divide how much the company is growing in terms of how much they're growing in sales versus how much the stock price is going up relevant to it. So if it's 1, that's generally considered a 1-to-1 ratio. If you have a 1-to-1 ratio, then things are valued pretty well, right? So a 1-to-1 ratio means that the company is growing just as equally as quickly as the share price is going up. But if it ends up going above 1 slightly, that's not too bad. That means the price is going up a little bit higher than the company is actually growing in terms of sales and income. But if you have a lower than 1 price to earnings ratio, then that means the company is growing more than the price is. The company is growing as a company. They're selling more, they're making more money versus how much they're being valued at. So less than a 1 price to earnings growth ratio, PEG ratio, that's also another pretty important metric to value companies at. I don't know too much about price to sales, price to book. Price to sales is just the price of the company to the sales that they have. But of course you have to account for expenses. Price to book ratio. I don't even really understand too much about that. There's a lot of stuff here that you don't really need to understand too much about. Another one you might want to pay attention to is the total debt to equity ratio. So this is how much debt the company has to the market capitalization. So Fifth Third has a 1.0 ratio of debt to equity. So they have about $21 billion in debt and they're also worth a $21 billion company. So that might be a little bit scary, and that's why the number is red here, because it's indicating, hey, this debt to equity ratio is a little bit high. But that's also kind of normal, because if you look at other banks have higher debt to equity ratios. Most banks, that's all banks do, is they give out loans to people. They give out loans to people to collect interest, right? That's what a bank is supposed to do. Bank of America has a 1.8 debt to equity ratio. Citigroup has a 1.2 debt to equity ratio. So again, you have to not only compare these numbers to, the entire rest of companies traded on the stock market. Just because a company has a 1.0 debt to equity ratio doesn't necessarily mean it's the worst thing in the world. If that's totally in line with all the other companies that, all the other money center banks in the country, that they're also going to have a high debt to equity ratio. But yeah, so these are basically the things that you should kind of be looking at when you're looking at whether or not to buy a stock, or whether or not you want to. When you're trying to value a company, that's what you're looking at. Don't look at the share price. That's another thing I forgot to mention. The share price does not mean how much the company is worth, right? So right now, Fifth Third is trading at $30.51. That has nothing to do with how much the company is valued at. So what's a good example? Berkshire Hathaway. Berkshire Hathaway is trading at, what is that, $285,000 per share? Here we go. Berkshire Hathaway is trading at $285,000 per share, the Berkshire Hathaway A class. So that's a lot of money. You can't go and buy an individual share of Berkshire Hathaway, likely, because you don't have the money to do so. Whereas you compare that to something like Apple, Apple's only trading at $187 per share. So you would think that Berkshire Hathaway, they must be so much more valued as a company because their share price is so much larger. But that's not true. Apple is valued at a $900 billion market cap, where Berkshire Hathaway is valued at a $479 billion market cap. The market capitalization, that's how much the company is valued at. Don't pay attention to the stock price. The stock price does not mean anything. It's all about the market capitalization. That's how much the company is worth. But yeah, so we're going through everything: price to earnings ratio, forward price to earnings ratio, price to earnings to growth ratio. Those are probably the biggest ones that you should be paying attention to, because I think that for the most part, if you follow those, you can you have to take things into consideration, which we'll talk about in a little bit, but Yeah, so this is all the kind of stuff that you should generally be looking at when you're first looking at a company, trying to value them and figure out how much they're worth. Next, let's take another look at an example of another company that I am invested in, Procter & Gamble. So I don't know if you guys know Procter & Gamble, but they're another company. They're another company based in Cincinnati. I know a lot of people that work for them. But they're a consumer goods company, right? They sell toothpaste. I think Tide is one of their brands. Like, generally speaking, you've heard of their products. They sell personal products like that. Consumer goods. I think they're called like consumer staples, stuff that people are always buying. And generally speaking, companies that sell consumer staples are considered a pretty safe investment. I invested in them right around here, around the $70 range, because they have been kind of not doing that well recently. You can see their share price has dropped from $90 to $70, and I thought that was a pretty good value. You know, the company had not been worth that little since 2015, and they're a pretty safe company when it comes to, they're a pretty safe company because, hey, people aren't going to stop buying toothpaste. You know, they're a safe company that's going to be able to generate sales and do pretty well, in my opinion. So I figured it was probably a pretty good time to invest in them. But let's go ahead and take a look at their stats. So they are valued at a $187 billion company, which might be one of the largest consumer goods companies. But let's go ahead and take a look at some of the other things. The price to earnings ratio is 17. So that's considered more normal. If you remember the bank's price to earnings ratios, or if we go back to Fifth Third, their price to earnings ratio was 9, forward price to earnings 11. Procter & Gamble is 17, forward price to earnings is 16. So that's considered like the average. I think the average price to earnings ratio for every company in the S&P 500 is currently around 17 or 18. So this is considered a pretty normal price to earnings. So it's not like it's anything too ridiculous, like the company is crazy overvalued. The price to earnings to growth ratio is a little bit high. But again, let's go ahead and compare that to some of the other consumer staples out there. The Clorox company, here's another company that's consumer staples, although a slightly different sector, but they have a 22, slightly higher price to earnings and forward price to earnings ratio, and they also have a much higher price to earnings to growth ratio. And I'm pretty sure if we go and we look at all the consumer staples companies, although maybe not Apple, but if we go and look at some of the other consumer staples like Coca-Cola, they have, again, a much higher 4.81 price to earnings to growth ratio. Unilever, 3.76 price to earnings to growth ratio. So again, you don't just want to take these numbers at face value. You want to compare them to other things in their industry. Actually, what is Apple's price to earnings to growth ratio? Yeah, they have a much more normal one. Apple's a really good company, which is why they're the most valued company on the planet. Maybe the first $1 trillion company in a few days. But anyway, sorry. Again, going forward, everything else looks pretty normal. I don't really know too much about some of these other things. You kind of have to be an accountant to understand like price to book ratio, because really you have to delve pretty far deep into statements that the companies put out to understand all of these other ratios. Price to sales is obviously pretty understandable, but price to book ratio, price to cash per share, price to free cash flow. I would argue that these are probably not as important as just basic price to earnings and price to earnings to growth. But again, also the debt that they currently have is, nothing too scary. 0.66 might be a little bit high debt to equity, but long-term debt to equity, 0.42. Not too bad of a thing. It's a pretty solid stock. And again, debt. A lot of people think about debt as a inherently evil thing, but companies take on debt all the time because debt is something that you can leverage to, if you go and get a brilliant idea for something, right? If you go and suddenly find a way to cure cancer, let's say, you suddenly found a way to cure cancer, but how are you going to make all the medicine to go and cure cancer for everyone? Because you just have like $1,000 sitting in the bank. What you do is you go out and you get a loan so you can go and then go make as much as you possibly can. You go to a bank, get a loan to make however much cancer curing medicine you can possibly do, and then, distribute that and then swim in money, right? That's companies will often go into debt, and debt is not inherently a bad thing. Too much debt that you can't pay off is a bad thing. But Procter & Gamble doesn't really have too much debt. And also, one thing I kind of neglected to mention earlier is Procter & Gamble pay a pretty nice dividend. A dividend, if you don't know what that is a little bit of money that's paid to shareholders every quarter or every year. So Procter & Gamble will pay $2.87 per share to shareholders every year, and they normally pay it either quarterly or sometimes monthly. Dividends are considered a pretty exciting thing because you get a guaranteed income, and this interest rate, this is like an interest rate, right? You get a guaranteed 3.86% income over the course of a year, which that 3.86% is pretty high. The yield on a 10-year Treasury bond right now is like, I think, slightly under 3% or around 3%. The yield on a 2-year is like 1 point something percent, or maybe 2%. So this is considered a pretty good interest rate, and dividends are an attractive thing to investors when companies are able to consistently pay out to shareholders. This is a pretty high yield company, and it's a company that I don't think this dividend is going to be getting slashed anytime soon. You know, Procter & Gamble, they are a pretty safe consumer staple company, and I thought they were a pretty good value, which is why I invested into them. But let's go ahead and take a look at another company. This is a bit of a meme stock, okay? Everyone on the Wall Street Bets subreddit loves this stock, but for good reason. This is Micron, okay? So Micron Technology is a semiconductor manufacturer for memory chips, and they, as you can tell, have a very good set of numbers here. So they're currently worth about $71 billion, and they currently have a price-to-earnings ratio of 7.34, and it's going down. Next year, they're projected to have a 0.56 or 5.66 price-to-earnings ratio with a 0.21 price-to-earnings-to-growth ratio, which is considered incredibly low. They've become a bit of a meme stock because everyone on the Wall Street Bets subreddit is trying to buy this stock and buy options for it and stuff. But that's for good reason. They are considered a genuinely undervalued company, even though they've been on a huge run, right? They've been on a huge run for a while now. Just at the start of the year, they were trading at a little over $40 a share. 365 days ago, they were at like $20, and they're up to $63 right now. But they still have very good financials. I mean, this is a stock that can continuously run, and I mean, it's kind of for good reason. They really were an undervalued stock, which is why everyone kind of freaked out about them, because they have very good financial numbers. They don't have a lot of debt. They don't have a lot of downside to them right now, and they have fantastic income for the price that they currently have. So they are trading very, very highly. Or people have a very, very exciting mindset when it comes to Micron. Generally speaking, though, when you go and see stuff that looks too good to be true, generally speaking, it is, okay? You can go onto the stock screener, and this is the stock screener again on FinViz, and you can go and look at stuff. You can say, oh, I want to find a company that has a low price-to-earnings ratio, and they are also a low forward price-to-earnings ratio and a less than 1 PEG ratio and everything. And you can find companies where they have seemingly very good financial numbers, but generally speaking, that's for a reason. I don't know anything about this stock. I just picked it randomly. These guys have a 0.39 price-to-earnings ratio, a 0.02 price-to-earnings-to-growth ratio, and this looks too good to be true, but generally speaking, that's because it is. If something looks too good to be true, then normally it is. Most of the time, if you find a stock that has a ridiculous set of numbers that look really good, there's something going on that if you go and research the company itself, you'll find out that, this company is actually doing horribly because of this, and this reason, right? You'll find out something about the company or something about the guidance, something about what investors in the market expect for the future, and you'll find out like, oh, okay, this was not actually a good investment because of whatever reason. Like you can go and if you just sort the entire market through companies that have a price to earnings ratio lowest compared to highest, you can find companies that have a 0.0 price to earnings ratio. I mean, look at this PEG ratio. Look at all this green. This is really exciting, right? But you can tell this company has not been doing well lately at all. I don't know what the hell this stock is or what's going on here. Greece, that might explain it. But yeah, generally speaking, don't take these stats just at face value. Make sure you do your research into the company, figure out what it is the company does, how they make money, what their guidance is for the future, yada, yada, yada. You want to figure stuff out before you go and just blindly invest based on a few of these numbers. But this is the kind of stuff that you should look for. And this is the kind of stuff that most people look for when they try and figure out how valuable a company is, how, what they're going to be able to do in the future, and whether or not they're worth buying. Anyway, this video kind of went on a lot longer than I anticipated it for. But yeah, again, let me remind you, it's just best to buy the S&P 500, okay? The S&P 500 outperforms individual investors and financial institutions 92% of the time. You should really just stick to the S&P 500. Don't even invest in mutual funds, okay? Mutual funds are a bit of a scam because even if they beat the market somehow, which most of them don't, but even if they beat the market, the fees that they charge you will eat into your returns, and you're actually better just investing in the S&P 500. So keep that in mind. If you just want to have the best possible returns, just go VOO or SPY, okay? And that's where I put most of my money. Understand that. But with that being said, it is really fun to invest in individual stocks. And, make sure that if you go and buy a company, don't put all your eggs in one basket. You should try and diversify a little bit. So, try and make sure you have a little bit of exposure to the financial sector. But hey, maybe the financial sector has a really awful day like today. So you also want to own something in consumer goods like Coca-Cola because, or maybe you want to hedge your bets with something like gold. But that's a discussion for another video. So anyway, I hope you guys all enjoyed watching today's video. I will see you all tomorrow with another episode where tomorrow I think we're probably going to start talking a little bit about cryptocurrencies and commodities. So I hope you're looking forward to that. But until then, thank you very much for watching. Good luck in solo queue and have a wonderful day.